assets that are performing well now, extremely well in some cases, data centers, for example, a business you're in, healthcare properties, another one, renewable energy, are expensive. It's a great time to sell. The prices are high, but you still have to reinvest. How do you find new things to buy at good prices, bargains, if you will, the kinds of prices that Brookfield and valuations that Brookfield is known for, when there's such a tailwind?
In addition to all of the money that's been spent in stimulus, all central banks took their interest rates to zero. And when you take interest rates to zero, you work backward on repricing everything else. And multiples for businesses ought to be higher. Valuations for real estate that are leased ought to be higher. Valuations for data centers ought to be higher. Renewables ought to be higher. All of those things. So the capitalization rates or the multiples are coming down, which means the values are going up. And so some of it is, if we're in a zero interest rate world, you may not be right that they have high values. These may be appropriate, and there are pools of money in the world, because the alternative is possibly owning a treasury bond, and if you own a treasury bond, you earn 1. You're doomed to 1. It's possible interest rates go negative and you make some more money, but you're probably doomed to 1.
Assuming interest rates, at least in this country, don't go negative, is that repricing done? Or is it still happening because not enough assets are traded?
Hasn't even started.
Hasn't even started?
Just starting. We're selling a building in London. It's just starting. And it hasn't started in New York because assets aren't trading, because people they're not comfortable yet. Remember, what you have to have is, these are great assets in great cities which have long-tailed streams of income. Even if you have a building that's let for 20 years, people are confused about what that means. But once this clears and interest rates are in a new low, cap rates are going to start coming down.
And valuations are going to start to where? Give me a sense of, tell me more. This is...
Look, rates could have been 4%. A cap rate in a city center office building might have been 4% before. It's probably going to 2. If we're in a zero interest rate world and people believe that we're going to be in a zero interest rate world for a while, and the Federal Reserve's told you that, then I see no reason for a long-tailed asset with 20 years of cash flows not to be at 2 or 2.5%. And a 1.5, just for arithmetic, you don't have to do the math right here, but it means a lot to the values.
Well, let's talk about that. If that building that was selling at a 4% cap rate prior to the pandemic would have fetched $1 billion, what's it going to fetch at 2% or 1.5%?
Yeah, north of 2. It's $1 billion difference. So I'll give you, here's just a small indication. When we built Manhattan West, we built one tower there. It's called One Manhattan West. It's 100% leased. It's now open. It opened during the pandemic. People might have said, that tower, geez, it's terrible that they opened a tower during the pandemic. Actually, it was fantastic, because the tower is 100% let to great tenants. Its cash flows are, once stabilized, $125 million a year and growing. And we thought we were going to finance it for 5%. We financed it under 3%. That's $50 million a year to the equity owner. $50 million a year of extra cash flow to the owner of the building. Replicate that across a lot of real estate. That's a lot of value to the owner.